Good morning, ladies and gentlemen. Welcome to seminar dan kuliah umum SinarKU. His Excellency, the Dean of Faculty of Economics and Business Gadjah Mada University, Mr. M.Phil M.Sc Ph.D. His Excellency, the Head of Economics Department Gadjah Mada University, Mr. M.Sc Ph.D. The Honorable Invited Speakers, Mr. James P. Walsh, Ph.D. from the International Monetary Fund, or IMF, and Mrs. Utami Setiastuti, Ph.D. from Economics Department, Gadjah Mada University. Thank you for your willingness to share your knowledge with us. The Honorable Moderator, Mr. Akhmad Akbar Susamto, Ph.D. from Economics Department, Gadjah Mada University. And also, respectable all participants of this seminar. Thank you for joining this seminar. I'm Valentino Isali, the Master of Ceremony for today. Our topic is Indonesia, Economic Outlook and Policy Priorities. For all participants, I inform you that if you want to follow this seminar in English, you may click the interpretation button on Zoom, and you can also click the English Bapak Ibu peserta seminar. Jika Anda ingin mengikuti seminar ini dalam bahasa Indonesia, Anda dapat klik tombol interpretasi pada Zoom, kemudian Anda bisa pilih bahasa Indonesia. Next, I would like to read our today's agenda. The first is opening by singing Indonesia Raya and Hymne Gadjah Mada. Second, the opening speech from the Dean of Faculty of Business and Economics Gadjah Mada University. The third, we will watch a video from IMF, and then we continue it to the presentation from all speakers and also discussion. And the last one is closing. For the first agenda, we will sing Indonesia Raya and Gadjah Mada hymn. Please for the operator. Marilah kita seru Indonesia bersatu, untuk akan aku hidup, aku hidup karena aku, bangsaku, lakiku, semua. Di dalam Pancasila, jiwa seluruh nusaku, ku junjung. Next, I will invite Mr. Eko Suwadi, M.Sc. Ph.D. to give the opening speech. For Mr. Eko Suwadi, M.Sc. Ph.D., the time is yours. Please.
Thank you, Valentino. Checks. Is that okay, my voice?
Yes, we can hear your voice.
Okay. Thank you very much. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Salam sehat untuk kita semua. Very good morning to all honorable speakers, moderators, and all participants of this SinarKU seminar this morning. I am very delighted to welcome you all to this seminar, Indonesian Economic Outlooks, Policies, Priorities. This is the seminar that is regularly conducted by the Department of Economics, Faculty of Economic and Business, Universitas Gadjah Mada. However, I think this morning's seminar is quite special because we are inviting Dr. James Walsh. Welcome to Gadjah Mada, although through the virtual meeting, and also Bu Sekar and Pak Akbar. And this seminar also conducted in conjunction with our 66th anniversary of this school. And moreover, I think the situation in Indonesia and also around the world that we are all experiencing the COVID-19 pandemic that is not only causing the crisis in health, but also crisis in economics. That is why the Indonesian economic outlooks and policy priorities is quite important for us. Especially this is going to be shared by very resourceful person from IMF and also from the Faculty of Economic and Business. I think all of us, all participants, we are waiting for the sharing from Dr. James Walsh and also from Dr. Sekar Utami. Because we are expecting that the Indonesian economic outlook will guide us from students who study further about the Indonesian economy, and also maybe for the business persons will guide us how to do business in the near future regarding the possibility of the economic growth and maybe the risk that may happen, and also some other factors that influence the Indonesian economy, and what kind of policies that need to be prioritized to overcome the possibility of risk that may happen. Of course, on behalf of the Faculty of Economic and Business, I would like to thanks to Dr. James Walsh for sharing with us. Thank you very much. It is an honor for us to welcome you, and to Sekar, and also Pak Akbar. And of course, also we are thanks to all participants of this seminar this morning. This is part of our sharing session because FEB UGM as part of the higher institution of economic education, we have responsibility also to share about the economic issues to our society, to our academic and also our business person. Once again, thank you very much, and have a nice and very valuable seminar this morning. Thank you very much. Selamat pagi. Assalamualaikum warahmatullahi wabarakatuh. Very good morning.
Thank you to Mr. Eko Suwadi, M.Sc. Ph.D. for the opening speech. The next agenda, we will watch a video from IMF. Please, for the operator.
Economic growth and financial stability makes the world a safer place, and economic policies affect people from the price of groceries to education, jobs, and prospects for the future. The ultimate goal is to have a solid economic foundation which helps countries withstand turbulence in financial markets, because we've seen that when an economic crisis occurs, it spreads from one country to another, hurting everyone. To keep the global economy running smoothly, 189 member countries work together to promote financial stability, prevent crises, and facilitate trade through the International Monetary Fund. The IMF does this by tracking the economic pulse of each of its member countries, by collecting and evaluating data, and providing advice on sound economic policies to benefit the health of the world economy as a whole. It also lends money in times of crisis. Countries in need can turn to the IMF to borrow money from its members to alleviate a crisis and return to stability. And in collaboration with member countries and other partners, the IMF shares its experience by training people on the ground on good policymaking and helping them build stronger institutions with the aim of achieving stronger economic growth. In the wake of the global financial crisis, the IMF is evolving to meet other challenges confronting the global economy, taking on issues such as the role of women in the workforce, inequality, climate change, and money laundering. This collaboration and sharing of information from huge land masses to tiny island nations is an example of what the founders of the IMF intended: countries of the world working together for the good of all.
Now, I will invite our moderator, Mr. Akhmad Akbar Susamto, Ph.D. To Mr. Akhmad, the time is yours. Please.
Thank you very much, Mas Valentino. Assalamualaikum warahmatullahi wabarakatuh. Ladies and gentlemen, colleagues, friends, a very good morning to you all. It is my great pleasure to welcome you this morning to this seminar, Indonesia Economic Outlook and Policy Priorities. My name is Akbar, and I'll be chairing the session, which will run for about 1 hour and 45 minutes up until 11 a.m. Pak Dekan, Pak Kadep, ladies and gentlemen, colleagues, friends, as you know that we will have two speakers in the seminar will give us updates on the recent condition of our economy and about how the economy will go further in the future, and also what kind of policies that we need to have a better situation after we pass the COVID-19 pandemic, hopefully. And our first speaker is Dr. James P. Walsh, the IMF's Senior Resident Representative for Indonesia. Before assigned to Indonesia, Dr. Walsh was an advisor in the Monetary and Capital Markets Department and has coordinating the Department Surveillance, Program Monitoring, and Technical Assistance work in the Western Hemisphere. Dr. James Walsh has led financial sector stability assessment for Azerbaijan and Algeria, and was also deputy chief for China. He has also led technical assistant missions on developing monetary policy framework and implementing macroprudential policy, and coordinated surveillance work in Asia and Latin America. Colleagues and friends, Dr. Walsh's analytical work has covered financial regulatory reforms, macro financial linkages, inflation, financing infrastructure investment, and also systemic financial risk. Dr. Walsh has a Ph.D. in economics from the University of Chicago and a BA in economics from the University of Pennsylvania. Our second speaker is Dr. Sekar Utami Setiastuti. She is an assistant professor and the director of undergraduate program in economics at the Department of Economics, Faculty of Economics and Business, Gajah Mada. Prior to her current position, Bu Sekar was the coordinator of macroeconomic dashboard, a unit focused on the analysis of the macroeconomic conditions of Indonesia. Dr. Setiastuti has a Ph.D. in economics from the North Carolina State University and an M.Sc degree from Durham University. So, ladies and gentlemen, colleagues and friends, without further ado, allow me to greet our first speaker, Dr. James Walsh. Pak James, good morning.
Good morning. Thank you very much.
Thank you very much for being with us this morning. Dr. James, you will have about 30 minutes to present your insight about the current situation of the Indonesian economy and also some kind of policies that you think should be taken by the government to improve our economic conditions. And if you are ready, I will pass the floor to you.
Okay, thank you.
Thank you very much. Okay, so Pak Jim, please, the floor is yours for about 30 minutes.
All right, thank you very much. I'd also like to thank all of the organizers at the University of Gajah Mada and all of the members of the Department of Economics who have invited me here today. I look forward to giving this presentation and then answering any questions that people have afterward and the discussion. Could you please put up my presentation, please? So next slide, please. So first, I'll talk a little bit about what the IMF is and what it does. So that's somewhat related to what was just presented in that video, but I'll explain a little more about the IMF's relationship with Indonesia. Then I will talk about COVID and how it has affected the global economy and the economy of Indonesia and some other countries in the region. How can countries respond to COVID and what have they done? And then how have their economies responded to these policies to try to cushion the impact of the disease? And what has Indonesia in particular done to try to cushion the impact of COVID on the economy and on society here? And then I'll talk about what's next. How do we deal with the current phase of the pandemic? And how do we deal with recovery from the pandemic? So next slide, please. Next, please. So first I'll talk about the IMF. So the IMF was founded in, next please, in 1944 when the, well this is, it's one back please. Okay, well the IMF was founded in 1944. Sorry, this is too many slides ahead. The IMF was founded in 1944 as a response to some of the dislocations that had happened in the global economy in the 1920s and 1930s. It's really 2 slides back from this. Okay, well, so at the time, there was an effort to try to have countries coordinate on how their exchange rates were determined and how countries worked within the context of the gold standard. The role of the fund has changed over time, but beginning in 1944, the goal was to try to encourage monetary and financial stability around the world, and that part of the job hasn't changed. The fund today interacts with countries in a number of different ways, but there's 3 that I'd like to talk about. They're not on this slide, they're on the previous slide actually, but the 3 areas where we mostly interact with countries are policy advice, lending, and capacity development. So on policy advice, we have multilateral advice where we publish reports twice a year that have our views on the global economy and on major issues that the global economy is facing. And we also look at issues that are facing governments' fiscal policies and debt issues, and a 3rd report on global financial conditions and how the global financial system is working. As I think most people are aware, the IMF also lends to countries that are having balance of payments difficulties or other difficulties with their economic outlooks. We are currently in the middle of the COVID pandemic, and during that pandemic, we've lent to a very large number of countries, I think about 90. We have an emergency assistance facility that we use to help countries that are currently undergoing a very big shock. So in the past, we've mostly used that for natural disasters, but now we are also using it for COVID. So this is a way that we can help countries support themselves during crises, such as the one we are currently experiencing. But we also lend to countries, it tends to be larger amounts when there are balance of payments difficulties. And not only do we lend in the case of balance of payments difficulties, but we also have what we call precautionary lending lines, where countries can qualify for a lending line, a line of credit from us, but they only draw on it if there's an emergency. And the reason those lines can be helpful is because they act as some reassurance for financial markets that in the event of a shock to the country's economy, then they can draw not only on their own resources, but also on the resources of the global community to help them return to stability. And right now we have a number of lending arrangements like that, these precautionary arrangements with countries, especially in Latin America. And that's an area where we are hoping that more countries might participate in the future. The third area where we work directly with countries is on capacity development. So that's technical assistance and training, where we try to help countries better implement their own economic policies. So we will work with country authorities on how to, for example, improve the collection of taxes, or improve the efficiency of government expenditure, or how to implement monetary policy, or look at financial supervisory issues. We have regional offices all over the world that do this training. The closest one to Indonesia is in Singapore, and quite a few Indonesian officials have participated in training programs in our office in Singapore. And since COVID, we've done more of that remotely. And we've also had quite a few people working through those remote programs as well. So now we've caught up to this slide. In the last 10 years or so, the fund has also looked at a range of newer issues that are crucial for the global economy and sustainable growth going forward. The three of those that I would mention are, this is a previous slide, so please go back one. The three issues that I would mention are, inequality. We're trying to take more into account and understand more how economic policies affect income inequality, and how income inequality affects economic policies. Another thing is climate change, which is probably the greatest challenge you're going to face in your lifetimes. This is an area where there's a powerful role for international cooperation, and the fund is trying to work with countries on how to establish a global carbon tax and try to bring down emissions around the world, and also to create more fiscal space for countries to mitigate the effects of climate change. And third, we're trying to focus more on gender and how different economic policies affect men and women differently. This is an important way to make sure that growth is more stable and more sustainable over the long run, by recognizing that the way that men and women interact with the economy is not always the same. And we have to bear in mind that this is an aspect of development that is very important for how growth will evolve in the long run. So now the next slide, please. So next, please. So Indonesia joined the IMF in 1954 and we've worked with Indonesia, therefore, for more than 60 years now. Our resident representative office, I'm the 21st resident representative in Indonesia, was founded in 1967. I'm pretty sure this is the oldest resident representative office in the world, but I have not been able to get our history department at the IMF to agree with me on that. They're not sure. We publish a report every year. I mentioned before that we provide policy advice to our member countries. So every year we do what's called an Article 4 consultation, where we talk with countries about economic policies and offer our views on what can be done to make sure that growth is stable and sustainable. Our last report on Indonesia was published in 2021. This number is a bit off. And we will be doing another consultation in the beginning of 2022. So what we do with Indonesia is similar to what we do with all of our countries. We work with the authorities on how to design economic policies. We try to listen to what they see as the main challenges the country faces, and we provide advice to them based on what other countries are doing and what we see as best practices. And we do a bit of training of officials to try to implement these policies and try to make the overall framework for economic policy more efficient and better. So the next slide, please. Next, please. Okay, so next I'll talk about how COVID has affected the global and Indonesian economies. So next, please. So as I think everyone is aware, COVID has had a very large impact on economic growth around the world. So that the top row of numbers is what happened to growth in 2020. So the very first row is what the IMF forecast 2020 GDP growth to be for the major economies around the world. So as you can see, in October of 2019, before the pandemic, we thought the world economy was going to grow at about 3.5%. By April of 2020, when the pandemic had already hit and things were being shut down around the world, we forecast global growth to fall by about 3%. And in the end of 2020, it actually fell by slightly more than that. The impact was felt very differently around the world. So for example, if you look at the Chinese economy, we forecast the Chinese economy to grow at almost 6% that year, but the Chinese were the first country to really get COVID under control. So in the end, their economy actually grew by 2% last year. They're the only major economy that managed to grow last year. As you can see in the Euro area and the US, there were relatively severe contractions. Indonesia and the ASEAN countries also shrank, though not by as much as the US or the EU. And looking to this year, we're hoping in some countries there's going to be a relatively strong recovery, but in other countries it will be a little slower. I'll come back later on to why the pace of recovery differs across countries. But the bottom line is that some of these numbers are going to change as we update our forecasts. But at the moment, the IMF is forecasting a very strong recovery in China and the US, 8% in China, 7% in the US, though I think the Delta variant is likely to cause us to reduce those forecasts probably in the near future. And Indonesia, where the pace of recovery is a little slower than it has been in the US or in China, we're expecting growth of a little bit below 4%, though again, because of the current outbreak, it's possible we will reduce those numbers later on. But what I would take away from this is that the effect of COVID on the headline number of GDP growth was very severe last year. This was the biggest economic shock the global economy has faced since the Great Depression or World War II. And only now are we beginning to come out of it, and not all countries are coming out of it at the same pace. So the next slide, please. So one thing I would say about how COVID has affected different economies around the world is that while every economy is different and while the pace of growth and the effect on growth have been quite different, there are some common things that happened everywhere. So two of these that I will focus on was that in emerging markets, there was a large collapse in demand in the beginning of 2020 as the pandemic got underway. And you can see that in these numbers where these are average numbers for credit growth and for retail sales across the different major emerging markets, including Indonesia. So what we saw was that the demand for credit, so from consumers that were looking to buy new goods or services, or companies that were looking to invest, this demand for loans to do that fell very dramatically in March and April and May of last year. At the same time, retail sales fell very quickly around the world. You can see that in April of 2020, retail sales basically collapsed across much of the emerging world as people stayed home and as the lockdowns began and stores were closed. So this big impact, which I think everybody remembers from March and April of last year, it was a very unusual, very stressful time for everyone. This had a huge impact on the economy and it was very sudden. And then what we saw was that retail sales in most economies began to recover a little bit in the middle of last year and then have slowly begun to rise back toward normal. Credit has taken a little longer to come back, but it is now coming back in most emerging markets. So I'll talk a little bit later about Indonesia's experience, but the bottom line is that this original shock was very severe everywhere, and it was quite severe in Indonesia, and countries have returned to, or beginning to return to a normal phase at quite different paces. On the right, you can see what happened in financial markets over the same period of time. So these are average financial flows in and out of some of the major emerging markets. And as you can see, in March and April of last year, there were huge outflows from emerging markets. Indonesia was no exception in this case. Foreigners owned quite a high share of Indonesian government debt at the beginning of 2020. And a lot of that debt was sold in March and April of 2020 as foreigners took their holdings of Indonesian government debt and converted them into what they saw as safer assets like US government debt or Japanese bonds. So these big outflows were unusually large and could have led to a lot of instability in the global financial system. They didn't, for reasons that I'll return to later, but these were very large outflows and again, a very large shock. Over the course of the last year, these flows have somewhat reversed and capital began to come back into emerging markets in the third and fourth quarters of 2020. That has slowed down a little bit now because of the Delta variant outbreaks, but there has been some beginning of a return to normalcy since the middle of last year, and that's also affected Indonesia. So next slide, please. Could you please put the presentation back? Okay, and the next one, please. So as I said, the pace of recovery is quite different across countries. And there are three reasons that account for this difference in recovery speeds. The first one obviously has been the pace of vaccinations, where countries that have been able to vaccinate people very quickly have seen a bigger and faster recovery than countries that have not been able to do this very quickly. So I think there's a lot of focus on the United Kingdom, which was the first big country to really vaccinate a lot of people, and on the US, which had a pretty disastrous handling of the pandemic for a long time, but then vaccinated people quite quickly. But since then, a lot of other countries have done a very good job of vaccinating very, very quickly. The Canadian government vaccinated almost their entire adult population in about 3 months. Other countries like Japan and Germany and France that had a very slow beginning vaccinated very quickly and have now surpassed the US in the percentage of the population that's been vaccinated. But because of this, vaccination not only reduces the stress on the health system and it reduces the number of cases, but most importantly, it also increases people's confidence about the economy and their ability to go outdoors safely. And for that reason, it's allowed there to be faster growth, at least until the Delta variant came around. But that has been a big component of this two-speed recovery that we're seeing. Another component has been policy support, that some countries have had much larger support through fiscal policy to try to help the economy through the pandemic. And we see that through temporary tax cuts or through programs to keep people in their jobs or to increase unemployment for people who lose their jobs, and also support for small businesses. Indonesia has done this as well. All countries have done this to some extent. And I'll come back to how Indonesia differs from other places. But countries that had more policy support are now seeing faster recoveries in general. And that tends to be the advanced economies. And then finally, there have been some aftershocks around the global economy. The big one is the Delta variant that we saw first in India. This new mutation of the virus allows it to spread very quickly and have a very big impact on economic activity and on health indicators. And now it's receded in India, but we're seeing it in other countries as well. So as we know, in Indonesia, there was a big outbreak here. That has now also receded. And we would hope that the fact that the virus has now really declined in Indonesia would allow growth to return to maybe where it was before this outbreak. And hopefully we can get back to stronger growth in the future. So the next slide, please. So the one implication that I would say for this different paces of recovery is that as the rich countries have normalized, so those are the green and yellow lines on the chart on the right, people have expected their economies to grow more quickly, and perhaps for inflation to come back, interest rates have begun to rise in those countries. So you can see this particularly with the US, that at the beginning of 2021, US bond yields rose quite substantially. I mean, it's a small number, but they added a lot to that small number. European bond yields also rose, though they're still negative, but by a lesser amount. And this is because the global markets expected growth to return and inflation to return. So this has the effect of pushing up interest rates in those markets. At the same time, because the pace of recovery was slower in Indonesia and in a lot of other emerging markets, Indonesian rates had some increase at the beginning of the year, but then that's pretty much receded now. And we aren't seeing the same kind of increase in rates in those countries. But what this means is that because interest rates have risen in the advanced economies, people are bringing capital back to the advanced economies. And the concern would be that if the recovery continues this way, that if the advanced economies continue to grow, to normalize more quickly than the emerging markets, we might see more capital going into the advanced economies and away from the emerging markets. So far, we haven't seen that happening in a major way, but it is possible that this could happen in the future. So the next slide, please. So just to talk about how COVID has evolved in Indonesia, we think about COVID in 4 phases. The first one was the acute phase A at the beginning of last year. And that's the time when, as I said before, retail sales fell very quickly, private credit declined very quickly, companies weren't borrowing, people were staying home, everybody was working from home for the first time who was able to. And we saw these big capital outflows from emerging markets. So at that time, there were not very many cases in Indonesia, but the economic impact was still quite high. Then there was this period through most of last year into this year where there was something of the beginning of a recovery. And around the world, we did find that people were better able to continue to produce output, and the economy was able to grow despite some restrictions. People got more used to working at home, people were beginning to order more things online, and there was a substitution away from goods and services that are in person toward things that can be done at home. So what we saw was the economy beginning to adjust to COVID and things beginning to recover. Then in phase C, we would say that's when cases began to rise again in Indonesia as a result of the Delta variant. And at this time, this is the artificial new normal between the two outbreaks. So in period C, this is between the outbreaks that we saw at the end of last year and the current one we're in. Things began to recover and the economy began to normalize a little bit in Indonesia. Restaurants began to reopen, people began to travel again. So this is what we thought might be this new normal and a return to regular kind of model of economic growth. But then the Delta variant happened, that would be phase D. And we saw a very rapid rise in cases, which has happened with the Delta variant everywhere. And while now that number of cases has fallen quite dramatically, there has been a real impact on the economy. And we'll see how much that goes in the next slide. So, next, please. So this new Delta variant outbreak has, well, not just the Delta variant outbreak, but also in general, the damage to the Indonesian economy from COVID has so far it's been severe everywhere, and Indonesia is no exception. So the 2 things I would focus on here are the charts on the right. So if we look at the return on assets of public companies, so how profitable have companies been on average, and how much profit are they able to get out of the assets and their investments? This number in Indonesia, so the general profitability of companies, has been falling for a few years, even before COVID, but it's fallen particularly during COVID and to quite low levels. So this is a concern because as the economy recovers and as we begin to move beyond this acute phase of the pandemic, we will need companies to be able to invest so that they can support higher growth in the future and build an economy that's growing and sustainable for everyone. But with profitability relatively low, this will be that makes it a little slower and a little harder to get back to that pace of growth. And the other one is what we call firms at risk. These are companies that don't have enough cash on hand to pay all of the interest payments on their debt over the next year or the next 2 years. So Indonesia has quite a high number of companies that are in this position. And again, this is a side effect of a relatively low level of profitability and a relatively high level of debt. Other countries also have high levels of companies that are at risk in this way. Singapore, as you can see, also has a very high number of firms at risk. Some other ASEAN economies like Malaysia and Thailand are high, but maybe not quite as high as Indonesia. But this also will be a drag on the economy, and it's something to think about as we begin to move past this phase in the pandemic. So the next slide, please. So the next thing I'll talk about is what different countries have done to try to address the damage from the pandemic. So first, we can talk about what different emerging markets have done. And there are 3 areas that I would focus on around the world and also in Indonesia. So those areas are how much was fiscal policy able to support the economy, And then how much did the central bank support the economy through monetary policy? And finally, what are measures that were undertaken to support corporates and banks so they could also get through the pandemic in a relatively healthy position? So on the fiscal deficit side, most countries, almost every country, had some kind of package of stimulus to try to support the incomes of low-income people, to try to support small businesses, and to try to increase health spending during the pandemic. Indonesia here, as you can see, compared to other emerging markets, had a relatively small fiscal stimulus. Part of that is because other countries might have had more policy space. They might have been able to borrow larger amounts because of bigger investor bases, or maybe they were able to cut taxes more than Indonesia was. But overall, Indonesia's fiscal policy support was relatively small compared to other emerging markets. On the other hand, the monetary stimulus was a little bit larger and a little bit closer to the middle. In the middle chart, you can see how much countries cut their policy rates. So how much cheaper did short-term credit become in different emerging markets based on what the central bank is setting its policy rate. So Indonesia cut the policy rate by a few hundred basis points. That's quite typical across emerging markets. And now the policy rate has been at 3.5% for quite some time. The central bank just agreed to keep it at that level for until its next meeting. So what this means is that the central bank has done what it can to try to make credit cheaper and make it easier for companies to borrow. In some advanced economies and even some emerging markets, these rates have gone down to zero. In Indonesia, they haven't gone quite that low. And part of that is because I think the central bank has come to the conclusion, and in our view correctly, that at the moment, the reason why credit hasn't recovered is because there's just not a lot of demand for credit, and that reducing the price of credit even further or reducing the policy rate probably won't have much of an impact. So what I would say in this case is that the central bank Indonesia has been about in the middle of what emerging markets have done in terms of monetary policy. And then the last area of policy is how banks and companies have been supported. Here, Indonesia has encouraged banks to restructure their loans to companies. So if the bank can determine that the company is likely to be creditworthy after the pandemic has run its course, then the bank will restructure the company's loans and try to collect them a little later. This is a typical kind of program that many emerging markets have done. Some emerging markets have focused on particular sectors like agriculture or recapitalizing state-owned enterprises, but there has been a large effort in every major emerging market economy to support companies and to keep banks liquid throughout the pandemic, and Indonesia is no exception here. So the next slide, please. But as I said before, the real key to getting a sustainable recovery in Indonesia will be vaccination and getting people vaccinated so they can go out again, see their families, and go back to in-person work. The pace of vaccinations is relatively fast in Indonesia right now, more than 1 million doses a day. It will still take a while to get to everyone, especially in more isolated areas, but the pace has really risen, and that means that the coverage of the vaccine, especially in priority regions like Jakarta and Bali, is actually quite strong now. So Indonesia, more than most countries, has had a very differentiated rollout across regions, where the government has focused on Bali because its economy was so affected by the loss of tourism, and on Jakarta, which is the center of the economy and the most connected place. So it makes sense to do it this way, but it also means that these two areas should be at a point now where the number of hospitalizations should remain quite low, even in the case of another outbreak. And we all hope that that can be the case for the rest of the country as soon as possible. Next slide, please. Now I'll just talk quickly about the different areas where the Indonesian authorities have tried to support the economy through the pandemic. So Bank Indonesia has been quite active throughout the pandemic in thinking about how to cushion the blow. So the first thing I would note is that they've lowered the policy rate. As I said before, this makes credit cheaper. In the middle, they've done quite a lot to stabilize financial markets, and in particular to stabilize the market for the rupiah. So the big spike you can see here is around the time when there was a lot of selling of Indonesian government debt by foreign investors. At that time, there was a lot of volatility in the rupiah, And the Bank Indonesia moved into the markets to try to smooth this volatility and try to ease the transition toward a new level for the exchange rate. And that was quite effective. And since then, they've continued to intervene around the exchange markets without really affecting the overall value in a long-term way, which is quite good. It's helped make the markets more predictable and make help the economy recover. And finally, the large deficits that the government is running have made it more challenging for the government to balance its books. So with foreign investors having sold a lot of debt, Bank Indonesia and also the private banks and the state-owned banks have stepped in and are buying more of these bonds than they used to. There is a concern when central banks buy government debt. In the past, that has led in some cases to instability. And the important thing is that such purchases are limited in time and that there's a very clear roadmap to making sure that in the long run, the central bank will not be the buyer of all of government debt. Bank Indonesia has had a plan to move out of these purchases in the long run, and that will help help make sure that this is sustainable over the long run. But for the time being, this was also an effective way to intervene in the government debt market and make sure that things were smooth and stable over this period of time. So next, please. The next thing I would talk about is how the OJK, the financial supervisor, has tried to encourage regulatory flexibility over the crisis. And as I said before, they've encouraged banks to restructure loans to creditworthy enterprises. So what this means is that during the COVID crisis, a lot of companies that might not have been able to pay back their loans. So for example, hotels or restaurants that had borrowed money and now don't have any customers and have to shut down, their loans have been restructured and extended. So it turns out at this point, between 20 and 25% of banks' loan portfolios have been restructured in this way. What that means is that banks' losses are not very large. A lot of the companies that might have gone bankrupt have not gone bankrupt. So the banks are not registering these as losses yet. It's possible that some of these companies will go under. And it's very important that banks monitor the risk of those companies going bankrupt and not being able to pay them back. To the extent we are aware, they are trying to do this. But what this means is that there's quite a large stock of debt, about, as I said, between 20 and 25% that is potentially at risk. It's not going to happen that this entire stock of debt will become non-performing and represent a loss to banks, but some of it will. So banks have to be able to distinguish these companies, and they should be paying close attention to this. And then the next slide, please. And then the third area I would talk about is how the government has supported health and income support. So the National Economic Recovery Program, the PEN, has been an effort to support healthcare spending, so hospitalization and testing and vaccines, but also to support social programs for low-income people and for small businesses. In this area, what I would say is that, as I said before, Indonesia's overall stimulus package has not been large compared to other countries, but what they have done has been quite targeted. So these are exactly the kind of programs that the fund thinks can best help the economy and best help people get through the pandemic. Social protection and healthcare expenditure in particular can help make it a lot easier for people and their families to get through the pandemic. And supporting small businesses is particularly important. So Indonesia's program has been very well designed. It has been limited by the amount of money the authorities have been able to spend, and in particular by the ability of local governments to spend a lot of this. So it's often difficult for local governments to spend in a transparent way and make sure that money is being sent to the right people. That's a challenge that every country faces to some extent, even advanced economies. This remains an issue in many places. And again, Indonesia isn't an exception. So the lesson to draw from this is that it's important over time to make sure that local governments have enough capacity to spend money in a transparent and efficient way. But those are long-run reforms. And to the extent that the National Recovery Program has been able to support quite a few people and help the economy and families through this time. So next slide, please. So then just to talk about how this has affected the global economy, the two things I would point out are that as the advanced economies have recovered and as they've begun to return to normal before most of the emerging markets, that means that their demand for imports has risen. So that has been very good for countries that manufacture both raw materials and manufactured goods, such as Indonesia. So overall, the global recovery has supported Indonesian exports. On the other hand, since growth here is a little slower, import growth is now beginning to recover, but it has been slower than export growth. So that has been good for Indonesia's trade balance overall. So next slide. And also, at least until the Delta variant, capital flows had also been quite stable with people, as I said, Indonesia's trade balance has been relatively good throughout the crisis, but also capital flows have returned to some extent, and people have not really reassessed how they see Indonesia's long-term prospects. So that's been quite important when we think about how the Delta variant has affected Indonesia. So what we saw here was a very rapid increase in cases and a very strict lockdown that happened especially in Java and Bali. But as you can see from the two charts on the right, there hasn't been much of a change in how expensive it is to insure Indonesian government bonds or in how the global markets see Indonesian stocks. So what that means is that global investors recognize that this Delta variant outbreak in Indonesia, even though it's severe, is temporary, and that the overall long-term prospects for the Indonesian economy haven't changed. If they thought that there would be a big change in Indonesia's long-term prospects, they would have sold Indonesian equities and they would charge more to insure against default, and we would have seen a bigger change in these numbers. But we don't see that. So that is good news that Indonesia is seen as handling the pandemic well and having a very credible policy framework, which is important. So next, please. And then the last thing I would point out about this is how credit has recovered. As I said before, credit growth had been slowing in Indonesia even before the crisis, and corporate profitability was relatively low. Credit did begin to recover a bit before the Delta variant outbreak began. So these numbers on the left were updated only for July. So we don't know yet what happened in August, but when we do, it's probably going to be a little bit worse. What I would say about this is that we will need government or corporate borrowing and consumer borrowing to support the recovery when it eventually comes through. And this decline in credit growth is quite worrisome in that area because we do need credit to grow. So what that means is that companies at the moment are relatively stretched, and we hope that when the economy recovers, that they will feel more confident about investing and begin to support the recovery. And on the right is just, as I said before, quite a large amount of debt has been restructured. And the concern would be that some of this restructured debt will have to be written off by the banks. And that in turn will reduce the amount of capital that banks have to lend. So this is another argument for making sure that banks understand the risks that they're facing and that they are adequately monitoring the quality of their portfolios. So next. So in terms of the next set of policies that we should be looking at, the first one, which I think is basically completed at this point, is how to reopen the economy during the pandemic. The IMF looked at how different Asian economies reopened in 2020, and one of the big lessons we found was that countries should wait until cases have fallen to a very low level before reopening. That's better for confidence and it's better for health. So it seems pretty clear that Indonesia has done that. You know, Jakarta is only really fully reopening now this week when cases have fallen by, I think Minister Luhut said 95%. So this is an important policy success. So next, please. The other thing I would say is that countries have been very supportive of the economy, and these policies will have to be unwound at some point. We'll have to bring budget deficits down. We may have to increase interest rates in the future, and we will have to return to normal ways of thinking about the loans that banks have to companies. But in the fund's view, these policies should not be reversed until domestic demand has recovered. So when the private sector is leading the economy, is leading economic growth, at that point, you can begin to think about normalizing these policies. So Indonesia isn't there yet, but when it is, that's when we should begin to think about normalizing these policies. And then I'd just like to talk about two more long-term financial reforms that we think would help stability in Indonesia. So the next slide, please. So one of these is that to develop Indonesian financial markets should be an important goal. And there are a number of reasons why this is important. So as I said before, the Bank Indonesia had to step in to try to buy government bonds as the budget deficit rose and foreign investors left. One reason that didn't have to happen in a lot of other countries was because those countries have bigger pension and insurance fund sectors that are able to buy these government debts and hold them. And sometimes these companies, these insurance companies or pension companies, will hold foreign assets. And then when the budget deficit rises in the home country, they will sell their foreign assets and buy more assets domestically. So these are very important actors to have in your financial system. And in Indonesia, they're quite small. So the government is aware of this, and the new financial omnibus law that is being developed is intended to include reforms that will support pension and insurance companies. But in the long run, this is a very important reform. It will help cushion, it will make it easier for the government to operate and finance deficits. It makes it easier for companies to borrow. And two ways where this is particularly important is you need these kind of entities to support long-term borrowing, both for infrastructure, where there will be there's always needs in any country for infrastructure investment, and Indonesia is clearly one of those countries. And then also for climate change. If we're going to address climate change in a serious way, we will need to do a lot of long-term investments in how we generate and transmit electricity. So pension and insurance companies are important buyers for the kind of loans that can help all of us move toward a better climate future. And then the next thing, the last slide I would have here is the next one is so the need to bring more people into the financial system. So there's an effort both through making the financial system more digital, making it easier to use, and coming up with new technologies that can help broaden access to financial services. We're trying to make the financial system more inclusive and make growth more inclusive. As I said before, the fund is concerned about how different economic reforms affect men and women differently. And one of our findings is that by making the financial system more inclusive, we can bring more women into the financial system, which makes it easier for women to start businesses and participate in the economy. These are all important reforms. Bank Indonesia is aware of this and has quite a comprehensive strategy for increasing the digitalization of payments and of the payment system overall in the financial system, and trying to bring more people into the financial system. And IMF research has found that by bringing people in, especially through digital means, that this supports economic growth and can help not only make the economy bigger, but also more inclusive and help people share the results of it better. So those are two reforms that will help make the Indonesian economy more resilient in the future. So that's my presentation, which I'm not sure I kept it to 30 minutes, but I tried. So I'm happy to answer any questions, and I look forward to the discussion.
Yes, thank you very much, Pak Jim, for your comprehensive and thought-provoking presentation. Okay, ladies and gentlemen, brothers and sisters, if you have any question, you can write your question by clicking the question answer button at the bottom of your Zoom page. Okay, and now let me greet our second speaker, Ibu Sekar. Bu Sekar, good morning.
Hello, good morning, Mas Akbar.
Thank you very much for being with us this morning.
Yeah, thank you.
Okay,
well.
if you're ready, then I will pass the forum to you, and you have about 30 minutes to present your insight about our economy and about, well, whatever, yeah, about the, okay. Bu Sekar, the time is yours.
Right, thank you, Mas Akbar. First of all, good morning. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera buat kita semua. Semoga everyone is in a healthy and safe condition despite this pandemic. I just hope that we're still, in a good mood. As Pak James said, that we're on a right track of recovery, so there's nothing much to worry about. Hopefully, not another mutation of virus. That's the most important thing that we have to think of right now. All right, so thank you so much for the Laboratory of Economics and the IMF, obviously, to invite me in this session. It's really, really interesting. Thank you so much, Pak James. It's nice to see you. And also thank you, Pak Eko Suwardi. I think I saw Pak Eko here, the Dean of Faculty of Economics and Business, UGM. We also have Pak Mahfud Solihin. Now, the thing is that the internet hasn't been really cooperating lately. I know that one of the assisting your operating your slides, Pak James, she had a problem with the internet, so it was pretty lagging. So probably that's why the slide didn't really match what you were explaining. So my apology. I have to turn off my video when I'm sharing my slides because it feels like we don't have a lot of bandwidth going on here, and I don't want to get stuck in like the presentation. So the thing is that Pat James has he told us a lot of things about the economic outlook, right? That the development of macroeconomic itself throughout the pandemic, and what's the response, not just for Indonesia, but also for some other countries in the world. So when I was invited to be the speaker in this session, I was like, there's no way that I would, present something exactly the same as Pat James. So I would like to use this opportunity to kind of like showing what we have been doing in Universitas Gadjah Mada, especially in the Department of Economics, especially in the macroeconomics working group. So I'm going to be talking about the research that's still undergoing, actually. Two of the research that we are doing in the research group. So I don't have a lot of things to, I only have like, I don't know, like 30 slides or something like that. I should be done before the 30 minutes. It's exhausted. All right, okay, so I'm going to start. I'm going to try to share my screen. Hopefully everyone could see this PDF, hopefully. So before I start the presentation, I would like to thank GIZ Indonesia, especially the Domestic Resource Mobilization for Sustainable Development, and the Fiscal Policy Agency, or BKF, in the Ministry of Finance for funding the research that I am going to present today. As a usual disclaimer, these views expressed here are those of the authors and do not necessarily reflect the views of the Ministry of Finance and the Government of Indonesia. And also ask the attendants not to cite any work that I'm going to present here because it's still ongoing. Everything is still in progress. We're still doing a lot of things. It's not ready for publication yet. So I'm really hoping that you would not cite anything here. But despite it's still kind of like a rough draft, but we're seeing something interesting in the research itself. There are two things. There are two research that I'm gonna be talking about today. First one is measuring the government spending multipliers. We haven't really come up with like a fancy or like fun title for this paper, so I'm just gonna put like that time varying bracket because we feel that if we talk about fiscal multipliers, pre and post pandemic, crisis, non-crisis, and different kind of environment, they would have different magnitude. And the second one, we're gonna model fiscal policy during the pandemic in Indonesia using a very different approach. So in the first paper, we're using vector autoregression, the time varying parameter one. The second one, we're using DSG model to do some counterfactuals and something that things that we feel like it's very important to be kind of like examined in the future. All right, so the first paper, I talked to my friends in BKF, the Fiscal Policy Agency, around like 6 months ago, and the government have this problem of having to go back to the fiscal discipline deficit of 3% by 2022, right? We know that because of fiscal stimulus, the number of the assistances, all kind of assistances that Pat James has mentioned before, for example, the cash transfer, the payroll, the tax cap, the assistances for the small, medium enterprises and things like that, it is very costly. The deficit has increased to around 6% of GDP, and that pushed the debt to GDP ratio to around 40%. This is unprecedented, but also necessary at the same time. The question is, we have so much limited fiscal space, and what kind of spending needs to be prioritized? It should be like when and what kind of spending needs to be prioritized. So we want to analyze the effectiveness of different types of government spending. If you look at APBN, you'll have like some posts like personnel or belanja pegawai, you have belanja barang or materials, capital, and social assistances. That's the belanja bantuan sosial. We want to look at how effective they are relative to each other and provide insight for future policy making. Now, the problem is that we don't have enough data pre-pandemic, right? If you want to do time series analysis, you know that you have to have a lot of observation of time period. We don't have that. So what are we going to do? If you look at the GDP itself, you only have like 4 data points, right? And that's like, it's very hard for you to work with that 4 data points if you want to look at the fiscal multiplier, because you essentially need more observation. This is why, as macroeconomists, that's our biggest obstacles of doing any kind of macro research, actually, the data. Then we have to go around this obstacles, the difficulties that we found by resorting to an analysis or a methodology that would allow us to generalize the estimation, not by looking at the average of the fiscal multiplier, but we're going to be looking at whether that multiplier is changing over time. So we're using time varying parameter factor autoregression model. The bulk of literature in this topic is done in advanced economy and via DSG model. So that's why we feel like we have a significant contribution in terms of looking at this in a developing economies context and in a more like macroeconometric approach versus DSG model. Of course, the DSG model has their own advantages. I'm going to tell you why and what later. That's why we also do DSG model for the same kind of topic to complete the understanding of what's really going on. All right, so from that DSG modeling, we see that different fiscal instruments have different multipliers for a different horizon. So for example, if you look at government consumption or like belanja barang in a sense, the impact is really big, but it's going to be diminishing over time, right? If you look at the other type of fiscal instrument, let's say that government investment, or you have belanja modal in that APBN, then if you look at longer horizon, the multiplier is going to be bigger. It's going to get bigger and bigger and bigger. Okay. So also, if you look at the other type of fiscal instrument, transfer and labor tax. Other papers also done the same thing. If you look at the different type of fiscal instrument, they have different type of multiplier. They have different magnitudes of multipliers, and that multipliers is going to be evolving. It's going to be increasing or decreasing as the horizons go up, right? So from this previous literature of DSGE, we kind of like having this confidence of if we look at the data, we're going to find the same thing. Right, so this is the TVP4 proposed by Primitieri 2005. This is a very, so I went to school in the US. This thing is very, very popular. Like you do time varying parameter of VAR, and then you're using Bayesian, say for example, Metropolis within Gibbs analysis, right? So that's one way to kind of like go around that problem of not like having enough observation pre and post pandemic. So as opposed to like the usual VAR, now you have that parameter of the lag of the endogenous variables to be time varying. So it's changing over time. The size of the shock of that spending, different type of spending, is also going to be time varying. Now, we're using Blanchard and Perotti, a very standard identification. We use 3 variables the change in government spending, change in tax revenue, and change in the output, right? So we have a lot of identification. This is one thing that we're doing right now. Also looking at this specification with different type of identification. So we gather monthly data from 2014, 2020. It's a monthly data of each spending. So spending on personal, materials, capital, and social assistance. We have tax revenue and we have the GDP. GDP is not available in quarterly data. So we have to interpolate the data into a monthly frequency or higher frequency using Chowlin method. This is something that we have to be doing as well in a robustness check to see whether that multiplier that we estimated would be sensitive to the method of interpolation that we're using. All variables are transformed into real terms and expressed in annualized percentage change. So how do we compute for that multiplier? So it's basically just the impulse response function, cumulative impulse response function of output divided by the cumulative impulse response function for the government spending. Again, each type of the government spending. And then we're just gonna multiply that by the conversion factor to go back into that multiplier that we are all very familiar with. If 1 rupiah, how much output going up if we have 1 rupiah increase in government spending. All right, so as I said before, this is like very preliminary result. Please don't sigh. So on the top left, that's the multiplier for belanja pegawai. So that's the spending on the personnel. On the top right, that's the spending on materials. Bottom left, that's the spending on capital. On the bottom right, that's spending on social assistance. So what's really interesting here, if you look at the fiscal multiplier, is time varying, obviously. Especially if you look at social assistances before the pandemic, the multiplier is really, really small, but then it gets really big. So it's increasing dramatically when the pandemic happened. So post-pandemic, we had a very high social assistant multiplier. As opposed to, if you look at like other type of spending, they're pretty, stable, right? And if you look at the capital itself, it's still very stable, although there's like a spike in the mid-2020. But all in all, if you look at here, different fiscal instrument would have different effect on output, be it in the short run or in the long run. So we're using impact, so that's like 3 months. That's the black line. We also look at the 6 and 12 month horizon in the future, right? So if you see here, so for example, the materials and the spending for materials and the spending for capital, they have a very, very low multiplier in the short run, but they have a very high multiplier in 6 and 12 months horizon. This is not surprising because all of these type of spending, they have this positive supply effect, as we call it. So these spending tend to increase the capital utilization of the firms, increase the labor demand, and so on and so forth, right? If you look at the social assistance, that goes right into the consumption of the household, especially if you look at the poor household. Now, the result is very interesting. As I said before, we found that the variation of these fiscal multipliers, the magnitude of how much the government spending, each type of government spending affect output is different. It's varying over time, but this variation do not look like it has a cyclical or a pattern. The multipliers of personnel, materials, and capitals are consistently positive throughout 6 and 12 horizon. And the most important thing is that during the COVID-19 pandemic, the social assistance spending produced the largest multiplier after about 3 months. But if you look at the social assistance, it's going to get like really low, even negative in the long run. Sometimes you're like, okay, what's going on? Like what's happening there? Well, if you look at the social assistance, it's only effective in the short run, because you have to look at also the effect of that social spending or spending in general to inflation, let's say, and how that inflation is going to be kind of like responded by the central bank. So if that spending is inflationary and there's no productive kind of like benefit out of that from, you know, increasing the capital utilization of firms, let's say, then it's going to be problematic, because if you increase in inflation without increasing the output in general, then the central bank is going to be responding by increasing the interest rate. So that's going to be affecting the cost of investment and so on, right? So so we're not just looking at like how that social assistance affects the income. So this, unfortunately, it's not. It's actually not relevant in this type of crisis, the pandemic crisis, for us to talk about social assistance and how that affects GDP, right? So because, you know, as much as we want to give money to people, if they don't spend, if they cannot spend, then there won't be effect to GDP. So that's something that we want to be looking at as well in the future, how the government spending affects other variables in that economy. So the caveat of this research that we've been doing is that the monthly data is generated using Shaolin interpolation method. It's not necessarily the best, so we have to also do robustness check on that. And we can only examine the effects of policy separately. Okay, so we're only looking at the shock of, let's say, spending on personnel to GDP. But that's like, you don't have the, in real world, that spending, the personnel, materials, and then the social assistances, they're actually being kind of like being given to the government simultaneously, right? So that's one of the caveats that of this paper. In the future work, we want to do a lot of robustness checks just to make sure that the estimation is valid, that the estimation is reliable and could be used for future policy making. Now, the thing is that we have this useful insight of social assistance being the most effective fiscal instrument in the short run. And if we're back to the kind of like post-pandemic, when people can actually spend and production is actually can be done without any restriction, probably the spending on materials and government investment should be intensified, right? So we need to know, if we want to design a fiscal stimulus package, we should understand the source of the crisis, how's that going to affect the multiplier? How's that going to affect the how's that fiscal instrument going to affect the output in general? Okay, so that's the some of insight that we got from this paper. Now, to really understand what's going on, so we were struggling with the way to explain the transmission mechanism from fiscal policy to output, let's say, or what if we have two policies at the same time? I have people annotating the PDF, so it's kind of like, okay. But anyways, so it's going to be very hard for us to look at that type of experiment using the macroeconometrics experiment that we did here. Okay, so this is just like macroeconomic time series analysis. That's very simple. But in the end, we want to look at more of the fiscal policy and the counterfactual and what if, right? So what if is the goal here? What if we have some sort of like different response, right? So we had a lot of response through social assistances. What if we have something else? Let's say, you know, probably the most interesting question would be like, what if we have unemployment insurance, right? Something that we cannot answer using this type of model. So we're doing more of the fiscal policy, but in a DSG context. So we're going to merge that, usual fiscal policy analysis into a DSG model, but with a banking sector and with two different type of households. So we closely follow Miguel Faria e Castro paper. So I thank Miguel for the appendix and the code that he's using to publish the paper. And then we calibrate that model to Indonesian economy. Okay, and then we're going to look at the effects of different type of discretionary fiscal policy. So the model is really, really simple in a sense that we have two types of households, worker borrowers. Those are like people who earn income from employment. And there are people that calls saver. They're like wealthier agents who owns firms and banks. Workers can be either unemployed or they can be working. If they're unemployed, they're going to receive unemployment insurance. If you ask me, do we have unemployment insurance in Indonesia? We don't, but we have to put it in there because we want to do some sort of like counterfactual in that sense. Okay, but we keep, in the steady state, we keep that unemployment insurance to be really, really low. So it doesn't have much effect in the dynamics. Now, there are two sectors. We have service sectors that is very susceptible to disruption due to the pandemic. That's like contact intensive sectors. If you look at like the hotel, tourism, transportation, food and beverage, right? Because, you used to go out every day. You go to the mall, you eat at the warung next to your house, you go to a coffee shop, you fly to Bali, you fly to Jakarta, wherever you are. But now all of those are like stopped, right? So that is the contact intensive sector, but also there's a non-service sector where the activity is not actually directly affected by the pandemic. So we have two households and two sectors in this economy. So how to model the pandemic? This is a very important, this is like a $6 million questions right now. If you look at macroeconomics and how they're struggling in the finding like the source of the crisis. We always talk about like shock and shocks, right? You can model this pandemic as a total factor productivity shock, right? If you're a very naive real business cycle theorist, you'll be like, okay, this is a total factor productivity shock because you're working from home instead of working from the office. With one labor and one laptop, you can only produce like half of the work that you did in the office, right? So that's like the reduction in productivity. But is it like that though? Probably not, right? Because I'm as productive as I am right now in my house than when I am at the office, right? So the pandemic is modeled as a sudden stop of contact intensive sector. So people used to go out having, food, they go to the movie, go to the mall, go to the spa, fly everywhere, take the train, take the bus. It's not happening, right? Because there's a lot of restriction in the labor mobility, let's say, or even from the household itself, because I'm so reluctant to go out. I don't want to go to the coffee shop anymore. I'd rather make my own, a cup of cappuccino at home because I don't want to get contracted. I don't want to contract it. I don't want to get the virus. Sorry. Now, that disruption in the contact intensive sector, that would cause the default, that's going to disrupt the financial sector, and that's going to amplify the recession. So unlike the macroeconomic time series analysis, the shock is not modeled as like one-time shock. So this is what's good about the model, is that because you can replicate a crisis where you have 2 or 3 or 4 waves. God forbid, 2 waves is enough. We don't want a third one, fourth one, etc. Right. So the shock will last for 6 quarters, and we're gonna model the peak of that crisis to be in 2 quarters. The first in the 2020 and also in 2021. That was on the quarter. That's on a quarter 3, where we have the PPKM for like 3 months now. And that's going to result in 8% of unemployment rate. Sorry. Now, the complete story looked like this. I think I have presented this so many times. You build a macroeconomic model with a lot of equations, but you have to be able to tell the story, using plain English or plain Bahasa. And it's going to look like this. I don't have a lot of time, so probably later you can read it yourself. But the bottom line is the shock happens in the service sector. That created disruption in the service sector, a drop in employment, because people in that service sector borrows from the bank. There's a lot of defaults. Banks don't, because of the default and because of the crisis, banks reluctant to lend to people. As you can see now, even when the central bank is lowering the benchmark rate, the loan rate is still very high. That's when you know that there's the financial market imperfection, and the bank are still seeing the loan as a very, very risky one to make. So that affects the decline in non-service consumption, especially when you have a lot of households that borrow to consume. That's going to affect the inflation. That's going to affect the demand for the non-contact intensive sector, and so on and so forth. So the overview of the model, I'm just going to talk about that for like 1 minute. So we have borrowers. These are like the households that they financially constrained, right? So they have to borrow to consume. If you look at here, that's the second line here, that's the budget constraint. So if they're not working, they're going to receive unemployment insurance. You have tax, the income tax, if you work for the service sector and non-service sector, and then you can also buy government debt. You're also going to get the cash transfer from the government. If you are a savers, then you're the one who deposit money in the banks, and then you can get like the interest rate from that savings. So this model, Miguel's model, assume that the demand for service is only happening for the savers. So the borrowers does not actually demand services. I think this is something that Miguel has also been, he extended that in the latest, version of the paper, the published one as well. Right. So the central bank, they follow a standard Taylor rule. They're using their model as having a zero lower bound. We're not going to use that in this context because Indonesia doesn't have that. The government budget constraint looks like this. The left-hand side that's the that's the expenditure. The right-hand side is the revenue, right? So, and then we're also going to be looking at mass of the firms in the service sector. You look at the service sector in general, how many firms are in there and have to go out because of the pandemic, of the default, and things like that. But, to ensure the government solvency, the tax is going to responding to the government debt. So when the government debt is going up in the previous period, tax has to respond. That's a very standard rule for fiscal sustainability. Now, we have to model the PEN programs in this context. So we have to model the government spending on materials. Then we have to feed into the model the path of the cash transfer. We have to also be feeding the model the path of the firm's assistance. Right. From this path of the government spending, then we're going to be looking at the shocks, right? The shock was from the service sector. The shock was the demand of service sector that's plummeting. How do we model that? How do we model the shock? How do we measure the shock that would kind of like match the dynamic of Indonesian economy? So we took the data from the BPS, the unemployment rate, and then we estimate a shock. Really, it's just like finding a shock that would allow the model to match the dynamic of the data. So the orange one is the data, that's the data of unemployment rate during the pandemic, and the blue one is the model. Of course, we don't have quarterly data for unemployment rate. Just for now, we're interpolating it using a linear method, right? So if you look at here, the shock of the demand of the service sector, you have two kind of like a peak, negative peak in Q4 2020 and also Q2 and Q3 2021. So with this shock, we're gonna generate the counterfactual of the economy. So if this is total factor productivity shock, this is a very, like, it's a baseline for, if you're familiar with the DSG model, you have to look at total factor productivity shock and whether that shock that you generated in this slide would have a kind of like a explanation that makes sense. If you look at the total factor productivity shock, the model generates a very kind of like a reasonable, prediction. If you look at the pandemic shock, this is really interesting because with the shock that we generated here, we created the counterfactual of the response of variables into the economy. So you see a very large dip in the GDP, a very large dip in consumer borrowers. Interestingly, savers consumer consumption, or like consumption of saver, is increasing. This probably because the savers are not really affected by the pandemic and the fiscal policy itself. The labor in contact intensive sector is plummeting. That's correct too. Inflation is also falling. Policy rate is falling. Default rate is going up, and the credit spread is going up as well. Now, we want to look at that baseline counterfactual, and then we're going to impose that with one policy. So for example, we're going to be looking at what happened if in that economy we have government consumption, and you see that the baseline, the blue one, and the one with policy, the orange one, there's like a slight difference. We're going to be doing different types of policies. So we have government consumption transfer to households, firms assistance, unemployment insurance as well. Now, the very interesting thing is that we're going to be looking at also as a fiscal multiplier. Now, we did try to measure the fiscal multipliers using the empirical analysis, using the historical data, but this model could also generate fiscal multipliers. So this is just the how much the different type of variables. We're going to be looking at like employment, income, GDP, consumer, savers consumption, borrowers consumption, with respect to the type of a different fiscal instrument. Now, this is the fiscal multipliers in the normal period. If you look at here, government consumption still has the highest multiplier, but if you look at the empirical data, government consumption as a belanja barang is actually generating a very small multiplier. But we think that this government consumption, because we don't have government investment, so as if that this government consumption is productive in a sense. Now, the other type of fiscal instrument, they generate a very small multiplier to GDP. Now, this is the fiscal multiplier that we generated during the crisis. So this is a crisis period. We're looking at the horizon, 4 horizon and 20 horizon ahead. So that's 1 year and 5 year ahead. If you look at here, it's very interesting because in the short period, if you look at the, say, for example, government consumption, the multiplier to employment is above 1. But as you go to a longer horizon, that multiplier is going to fall below 1. And what's really interesting as well, if you look at unconditional transfer, it's from like the perspective of the horizon, the short and longer horizon. If you look at the longer horizon, the multiplier of unconditional transfer is actually lower than if you look at it in a short horizon. Okay, so from this model, we get the it's kind of like it's validate our our thoughts that, okay, this type of fiscal instrument, different type of fiscal instrument will have different type of, different magnitude of multiplier in a longer horizon or in a short horizon, normal period versus crisis period. But, so I think I'm like 6 minutes way past my allocated time, but anyway, this is the concluding remarks. So both short run and long run, if you look at the table here, the largest multiplier on employment, income, and borrowers' consumption is generated by unemployment insurance. So of course, we don't have unemployment insurance here. This is a counterfactual. Why we think that it is good? Because it's very well targeted in terms of its timing. So you don't have to wait for 1 month, 2 months, 3 months to actually handing out the assistance to people that lose their job. Okay. And then if you look at unconditional transfer, it generates a small multiplier on GDP, but a high multiplier on income and borrowers' consumption. So I think it's very not empathetic for us to only look at the GDP when people are struggling to make ends meet, right? So in a sense that you wanna look at the multiplier, it is better for us to look at like different type of variables. And this way, this model can generate multipliers for different type of variables. And income is very, very interesting as well for the household. So the caveat of the model is, this is a very simple model. It takes many shortcuts and it's abstract from important things. This is something that we want to do in the future. For example, adding government investment. That's also a very important discussion within the government of Indonesia itself. And then we're also going to add informal sector to the model, because if you look at the labor market of Indonesia, it's dominated by informal sector. And I think it's very interesting for us to look at how the pandemic affects the informal sector. The future work also includes model. Yep.
Maybe another 1 minute. Or 2 minutes.
I'll stop in 30 seconds. So, so the most important thing is to do model validation. We just make sure that we're really tidying up the calibration, or do some sort of like estimation for this model. We're also interested in examining the effect of multiple instruments at the same time, not just one. Okay, so we want to try to look at what if we focus on one type of fiscal instrument as opposed to the other. So from this pandemic, from what the PEN program has been kind of like administered, then we can see, what is actually the best in terms of the mix of the instrument itself and when it's going to be deployed. All right, so that's all for me. I think I have put all of the references if you're interested in look at the literature. Thank you so much. Was that more than 30 seconds?
Thank you very much, Sekar. Okay. Thank you very much for your interesting presentation. Bapak, Ibu, ladies and gentlemen, colleagues, friends, now we are about to have a question and answer session. But just to remind you about what has been discussed before, Pak Jim has discussed about several topics. He start with a brief explanation about what is IMF, about what it does, and then Pak Jim also mentioned about the relationship between COVID and the economy, how the COVID-19 has how the COVID-19 pandemic has affected the economy, and then we also explain about what can be done by countries, including by the government of Indonesia, and also he explained about what kind of response that has been given by the government, including the government of Indonesia, and also he explained about what is next after that. Bu Sekar discussed about a more specific context where she developed a model to analyze the macroeconomic impact of the COVID-19 pandemic in Indonesia, and he explained some details of the model that she developed. All right. We have about 20 minutes for this question and answers session. And Pak Jim, okay, Pak Jim is already here. Yeah. Okay, and Bu Sekar. Okay, anyone has any question? Please raise your question. You may write your question on the chat because I do not see any question here at the question answer button. Or if you want, you can raise your hand, and I will invite you to raise your question directly. Anyone? Not yet.
If anyone doesn't have any question, I think I'm the one who's going to ask Pak Jim.
Oh, really? Okay, oh, that's fine. Then I'll give you the chance. Yeah.
Yeah, because Pak Jim gave like a really interesting presentation, and some of the things are very intriguing, because if you look at, say, for example, the effects of the pandemic to banks, let's say, what happened if OJK stopped their support? Like, what's the exit strategy as of like, IMF analysis? How's that going to be administered? Because if you look at now, the bank is not really struggling because they have OJK supporting them, right? But what is really the exit strategy to overcome the potential vulnerability coming from the banking sector? I think that's something interesting that we want to put also in the model, but I think I want to know how Pak Jim's...
Okay, Bu Sekar, thank you very much for the question. Please, Pak Jim.
Well, actually, first I'd like to thank Bu Sekar for a great presentation. It's really great to see that there's such interesting and relevant research being done at UGM, and I'm very interested in that topic. That's exactly the kind of thing that the IMF is interested in. Is looking. I mean, there's actually quite a few IMF names in your references there too, which I was happy to see. But it's really great to see this kind of research being done for Indonesia. So that kind of policy relevant research can only help improve the dialogue here about what kinds of policies work, and also inform the global dialogue about how some of these ideas might differ across countries. So I'm very happy to see that, and thanks very much for a great presentation. In terms of the OJK policies, these aren't the kind of policies that you can just reverse overnight. The banks have to make plans about where they think their capital levels are going to be and what kind of assets they're going to hold. So the OJK originally set a deadline that was quite far out, and the idea would be that banks would have an idea of when they need to get back to a normal state of behavior before the crisis, and they should be preparing plans throughout this entire time to do that. So at the moment, so there's kind of two ways you can think about it. One idea would be that you can set the deadline so far out that the banks will have plenty of time to adjust, but then it's an arbitrary deadline, and you have to make sure that the economy will have adjusted in that time. The other idea is you can have indicators that tell you when the economy is beginning to return to normal, and then the banks should have those as guideposts for when they have to begin to adjust their own balance sheets and capital positions to adjust to that. So these both have pluses and minuses, but what I would say about how the OJK is handling it is, at the moment, it's too early to really withdraw this advice. So you need to have a continued period where the banks are continuing to restructure the loans of creditworthy borrowers. And how they eventually unwind it is, there's pluses and minuses either way, but the important thing is to make sure that the banks have enough time to adjust. And during that period, what the banks should be doing is being very objective about their own borrowers and saying, maybe a year ago, it looked like this company could survive for another 6 months, but now, because of the Delta variant, it might not survive. And at that point, you have to think this is a loan that may not be paid back, and they should begin to hold provisions against that loan. And they should be thinking through their whole portfolio this way, and then thinking once this guidance eventually expires in March of 2022 or now March of 2023, where will our capital position be? Which of these loans will we have to write off? So that's how we would suggest that they think about it. If there aren't other questions, if there's other questions, I'm happy to answer them, or I can ask a question to Bu Sekar.
Yeah, Pak Jim, thank you very much for that answer. We have a question here from a student, I think, from Mas Tito Satrio. So what kind of instrument can be used by the IMF to help developing countries in dealing with the COVID-19?
I think the main thing that we can do is try to share lessons that other countries have done and try to talk about what kinds of policies have worked in other places. So just as one example, a lot of people are comparing the current environment to the environment that happened in 2013. So right now, the Fed in the United States has injected a lot of liquidity into markets and interest rates are very low, but the American economy is beginning to recover. So the Fed will eventually reduce these purchases and begin to tighten monetary conditions in the US. The last time they did this was in 2013. And at that time, these policies weren't very well communicated. And there was it surprised the markets. And because of that, a lot of investors sold assets in emerging markets, such as Indonesia. So at the time, this was we call this the taper tantrum. So at the time, this was quite a shock to global markets and to policymakers around the world. But we and certainly Bank Indonesia, other central banks around the world, looked at what happened during the taper tantrum. And since then, we try to work with countries on how to implement frameworks that will make economies more resilient to this. So Indonesia has really been a leader in this area. Governor Perry and Bank Indonesia have really thought very, very hard and very clearly about what kind of tools they have to deal with financial instability, so that if something like the taper tantrum comes up again, then I think the BI is very well prepared to handle that kind of volatility. And this is the kind of set of tools that we talk about with Indonesia, but also with other countries that aren't quite as advanced in these frameworks.
All right, thank you very much for the answer, Pak Jim. And we have another question here from a student, from Colby RD. Thank you very much for the question. So the question is this: the IMF has distributed a special drawing right in August 2021, and in order to support the economic recovery in several countries. So my question is, how is the transmission of the special drawing right will affect the economic growth of maybe Indonesia?
So the special drawing rights, I always hope this question doesn't come up because they're very hard to explain to people. So if you don't, for the people who are watching, so I guess there's 255 people on the call. If there are 50 people who know what a special drawing right is and how it works, then I'm going to be very impressed. So the special drawing right is a tool that we use that allows, it gives central banks around the world a little bit of extra reserves that they can use. But these reserves are denominated in an artificial currency that the IMF uses called special drawing rights. So you can't actually buy anything with special drawing rights. But what you can do is swap those SDRs for usable currencies, so for dollars or yen or euros or British pounds, and use those to buy real assets. So the reason I have to explain this is because everybody's stock of SDRs has gone up as a result of this new SDR allocation, but not everybody has to use it. So, for example, Indonesia has gotten an additional contingent of SDRs. So there's a little bit more SDRs in Indonesia's account, but since they're sitting there in this artificial currency right now, there's nothing that's done with them. If Indonesia wanted to swap those SDRs with another central bank for dollars and then use those dollars to buy American government bonds or other reserve assets. But it's up to the Indonesian central bank and to the authorities what they do with that. So what we hope will happen with the SDR is that low-income countries in particular, or countries that are very affected by COVID, will take those SDRs, swap them with the rich countries, and then they can use the dollars that they get from that swap to buy bonds and to support their economies. So it's not that we expect it to have a huge impact on headline global GDP growth, but what we do hope is that it can be used by some of the low-income countries to try to support them and to try to keep them going through the pandemic. And whether Indonesia uses them either for its own purposes by swapping them into dollars, or whether Indonesia takes its own dollars and swaps those to a low-income country to help that country, that's up to the BI.
Thank you very much for the answer. Okay, we haven't got any further question. Please, anyone, if you have any question, please write on the chat button. Pak Jim, I have my own question while waiting for the audience to raise their question. And also I will ask Bu Sekar as well, actually. Okay, Pak Jim, you know that recently Janet Yellen, the Minister of Finance of the United States, has raised an issue about the possibility to have more debt for the government of the United States. And you know that the debt of the United States has been very large. It is more than 125% of their GDP. Whereas here in Indonesia, we have only like 40% is already a big issue. Huh? Politicians already talk about that. Wow, we have so big, so much debt, something like that. Yeah. So, what do you think is this kind of issue? The over debt in the United States might affect the global economy and also the economy in Indonesia as well.
First on the U.S. side, yeah, the debt burden is very large in the U.S. and I don't know what's going to happen with it. I mean, there's a lot of long-term fiscal challenges that the U.S. faces related to aging. All advanced economies face these. And at the same time, population growth is very slow. Productivity growth wasn't great before the pandemic. Maybe it did increase during the pandemic, so maybe that will help. But over time, the U.S. is going to, so some of this will correct automatically. The deficits will fall because the emergency programs that the U.S. has approved over the course of COVID, those will wind down. As the economy recovers, taxes will rise. So the deficit will get smaller over time. The question is, will the debt stock continue to grow faster than the economy is growing? As long as the debt stock is growing more slowly than the economy, then there's not much to worry about because the ability to service the debt is rising faster than the debt itself. In the US, the concern would be that right now, that's probably the case. Interest rates in the US are quite low. The 10-year bond yield remains, I think, I haven't looked in the last couple of days, but well below 2%. I can safely say that. So if that's the case, then US GDP growth nominal GDP growth is much higher than that. So the debt stock will fall relative to GDP. The issue is what happens if inflation rises and US interest rates begin to rise and growth slows. If that happens, then there is a serious concern. And of course, as these long-term fiscal challenges come up, they'll have to figure out a way to pay for that. And that's going to be an issue too. But the fact is that maybe 15 years ago, we would not have thought that any advanced economy could support the kind of debt burdens that most advanced economies now have. The Japanese government has been running large deficits for a very long time without a noticeable impact on the value of its currency or on growth. Japanese GDP growth has been very low, but population growth is negative. So productivity growth and income growth have actually been reasonable in Japan for the last 10 years or so, and even inflation began to rise before COVID. So it seems that advanced economies under current circumstances are able to support much larger debt burdens than we would have expected. So as for the effect on Indonesia, the fund is not particularly concerned about Indonesia's stock of debt. So we have a debt sustainability analysis that we do as part of every annual consultation. And you can see that if you Google IMF Article 4 Indonesia, we have a debt sustainability analysis that we published earlier this year. So our view is that we expect deficits and debts to rise during the COVID pandemic. And then we expect as the economy recovers that those will shrink again. Indonesia has a budget deficit rule that has been very effective over the last few years. And the government has made it clear that they expect to return to this 3% target in 2023. If that target is achieved and if growth goes back to normal, then I don't think there's anything to worry about with Indonesian debt. It's as you say, it's much smaller than US debt or Japanese debt or a lot of the advanced economies. The interest rates are higher in Indonesia. The borrowing rates are much higher. But if economic policy management continues to be good in Indonesia, as it has been under Governor Perry and Minister Sri Mulyani, then the cost of borrowing will eventually fall. That's why interest rates fall over time, is because of a sustained track record of good policy management. So we think our view is that Indonesia's debt is sustainable under the current assumptions and under our views about where the economy is going. Though that doesn't mean that we think the deficit should be 10% forever. It's only sustainable because of the real credible policy that the government has implemented over the last few years and what the central bank has done too.
All right, thank you very much, Fajim. Now I will move to Bu Sekar. Bu Sekar, I have a question. As you know that last year, our government was quite confident about our condition, and the government say that, well, by December 2020, you should have the vaccination, and then our economy will recover soon in 2021. And because of that kind of a perception, then at the time they decide to cut the government budget for program pemulihan ekonomi nasional, right? From National Economic Recovery Program, they cut the budget from more than for about 600 trillion to only less than 400 trillion, and then only after that they realize that they are wrong. Yeah, they made mistake, and then they changed the budget, and then they increased the budget to more than 700 trillion. So my question like this: my question is this? So how do you think is this kind of mistake, this kind of misprojection, yeah, might affect our macroeconomy? Yeah, especially this is one by the government, you know, as the government made a mistake in their projection, then they have to reallocate the budget, more than 300 trillion budget in their they have to gather all of them, and then all of this budget, and then to use for the National Economic Recovery Program. So what do you think about that, Bu Sekar?
Before answering your question, Mas Akbar, this is so annoying. We're doing paging tests in the apartment. So if the fire alarm is on, then I'll just have to stop answering your question, and probably we can move on to the next question, and I'll answer
That's
that
fine.
after.
All right, yeah.
Right. So yeah, I mean, okay. So unfortunately, we're dealing with like different type of crisis, right? Nobody has ever, foresee this type of crisis happening before. We haven't had health crisis in a macroeconomic context. If you look back, if you look at, macroeconomic model, the theory-wise, there's nothing out there. Probably like one or two. But then the whole thing happened, and we don't really know what's going on. First of all, I think we have to look at from the epidemiology side. We really have to know what's the nature of the crisis and how's that crisis going to evolve. We didn't think that a mutation of virus would wreak havoc. Like, this is the worst we've ever been since early 2000, right? Like, nobody has ever foreseen that we're going into a PPKM for like 3 months, right? I was like stuck in Bali for 3 months, well, because I couldn't get to the plane because it was so hard to find flights, and it's just something that we haven't. So I think I'm not saying normal. I think it's hard for us to create a good forecast, because the thing that driving the crisis is very unpredictable. Now we're looking at vaccination. We thought it's going to be effective. Turns out it's not effective. Well, it reduced the risk from you get like a very severe condition, but you can still contract the virus even though you're vaccinated twice. So what happened here is that we are, as an economist, like there's nothing in terms of like forecast wise, but how do we anticipate this in the future? So I think Pak Jim mentioned a very important thing to do, which is fiscal policy reform, right? How do we have that money without having to, budget it before we actually have to, give the money to the people, right? It's going to be hard if we kind of like react in a lag wise, like 3 months, 2 months, 4 months after the pandemic happened. What if we have a better automatic stabilizer? What if we have a better way to finance ourselves rather than relying so much on a foreign investors, let's say? Having the pension fund, having the system that allow us to kind of like finance ourselves, again, because this is everyone needs money in this, every country needs money to pay for the fiscal stimulus, right? How do we get that money? Probably we're not going to have a lot of money from foreign countries, from foreign investors. We do have a kind of like, a big demand for the government bond lately. Probably that's because of the saving rate itself has been falling so much. So there's like a migration from the third-party fund in the bank to the government bond, let's say. But that's not going to be sustainable if you look at the economy, and it's still going to be contracting for, you know, for another, like probably like 2 quarters. It's not going to be sustainable. So fiscal policy reform is very important in terms of like, how do we spend our money? If you're in a crisis period, how can you react in a timely manner, like in such, you know, short period of time, without having to have some sort of like law changes or things like that has to go through the House of Representatives, and this is something that we have to look at as well. We've been looking at the banking crisis. Let's say we have the KSSK. Why don't we have something for this type of crisis as well, right? So like a crisis management system, but in a different form. Yeah, unfortunately, this is something that is impossible to forecast, but I think fiscal reform in the future is needed. Thank you.
Thank you very much, Sekar. All right. Oh, very interesting discussion today. Pak Jim, Bu Sekar, and all of the audience here. Unfortunately, it's now 11 a.m. It's already 11 o'clock. So I'm afraid that we have to finish this discussion. And thank you very much once again to Pak Jim and also Bu Sekar and also everyone here who has attended this discussion. Okay, but I think Pak Jim, perhaps you have a very brief statement just to close our seminar this morning, and also Bu Sekar after this.
Well, thank you very much for inviting me again. This was a very helpful seminar. I particularly appreciated the chance to see some interesting research that's being done at UGM. It's really great to see that in any context, and this is certainly very relevant and very high-tech and useful research that Bu Sekar and her colleagues are doing. So it was great for me to be able to see that. So thanks very much for inviting me, and I look forward to seeing everybody in person someday too.
You are welcome. Bu Sekar?
Yeah, no, I'm just want to say thank you to Pak Jim for a really great insight about the economic outlook. It's really great to see IMF coming to UGM. I think this is something that we have to do as well in the future for different type of topics. I know that you have a lot of research, interesting research going on. Also, thank you everyone here, students, colleagues, dean, vice dean, everyone who make this event successful. Thank you so much for inviting me.
You are welcome, Bu Sekar. Ladies and gentlemen, Bapak Ibu, brothers, sisters, everyone here, please give applause to Pak Jim and also Bu Sekar. Thank you very much once again, and hopefully we can. I'm looking forward to see you again in the future, and hopefully every one of us will be always in healthy condition. It will always be in our best, yeah, to do whatever we are going to do. Yeah, thank you very much once again, and apologize for any mistake, for any I forgot. All right, thank you very much, and see you again. Assalamualaikum warahmatullahi wabarakatuh.
Thank you very much.
Thank you, Mas Akbar. Thank you, Pak Jim. Thank you. See you again. Thank you.
See you soon.
Thank you very much for Pak Jim, Sekar, and also Pak Akhmad Akbar Susamto. Well, this is the end of our seminar. Once again, thank you to our speakers, Mr. James V. Walsh and Mrs. Utami, also our moderator, Mr. Akhmad Akbar Susamto, Ph.D., and also all participants who have come and joined this seminar. This is a good seminar, and I hope we get more knowledge from the session and our discussion. I also remind all participants to fill up the feedback survey on the chat box to get the certificate. Bapak Ibu peserta seminar, saya mengingatkan kembali untuk dapat mengisi form feedback yang ada dalam chat box di Zoom untuk mendapatkan sertifikat. I apologize for any mistake. And once again, thank you very much, and see you in the next SinarKU.
Thanks, everyone.
See you, Pak Jim. See you,
Thank you, Pak Jim.
Much.
Bye.